Welcome everyone and welcome back towards this new stream here on the channel, because today I will be talking about the FOMC meeting. In this exact live stream I will be going over what will happen towards the Bitcoin and cryptocurrency market today, and more importantly, Bitcoin is absolutely skyrocketing up and down right now. The volatility is picking up, so I will be discussing the price action of Bitcoin today, and I will also reveal my next trade I am currently taking. So without any further ado, I will straight away go in towards the content to talk about what I am currently doing and also about what my next trading position is here on the market, because right now Bitcoin is absolutely moving up and down like crazy. Currently, I'm already $260 in profit, or 6% in profit, I can say, because I have been opening up a long position on this small little correction towards the downside, because I am actually expecting Bitcoin is going to be having a bullish breakout right here. And you can see I'm already 10% in profit. Bitcoin is moving up like crazy. That is pretty interesting to see right now. But let's go straight away in towards the content. We can see Bitcoin moving up, and I've got a long position open. That is very beautiful. So what can we currently see? We are looking at a symmetrical triangle here at the Bitcoin price action on the 1 hour time frame. And I have been talking about it. I've been tweeting about it. And right now we can start to see it is finally starting to be breaking out. So I am trading this. I have been expecting it's going to be breaking bullish, and due to that reason I've also have been opening up a long position, and like we are currently doing, we are also breaking towards the upside. So Bitcoin volatility finally picking up again, and we are on the right side this time around. Furthermore, looking at the price action on the 15-minute time frame, we can see a very big squeeze pattern towards the upside getting created. And to give you a very quick general overview to know where we will be talking about on today's live stream, is that basically in this live stream I'm going to go and discuss live the FOMC meeting, because I will be discussing live the FOMC meeting here on the channel. I will be going over what the interest rate hike is going to be. So far, there is no interest rate hike decision out yet, but the market is already starting to be moving up and down. Yeah, basically, volatility is already starting to be picking up. But in this stream, I will also talk about what happened previously around with the FOMC meeting, because I've got some very interesting data. So make sure to stick around till the end of the stream. It's going to be a very interesting one here. First of all, let me do my analysis here on the Bitcoin and cryptocurrency price action. We can see in the 1 hour time frame for Bitcoin, we're forming this symmetrical triangle. This is actually quite a beautiful one, if you would ask me, right? I honestly like this symmetrical triangle quite a lot here, and the breakout target is going to be quite significantly. If we're going to be having a bullish breakout right here for Bitcoin, we will be expecting to see a movement all the way back up here towards levels around 21.4k, and that is actually quite a severe move, because if we're going to be measuring it on a price target of a percentage wise, it's going to be a 4.6% move, and that is why I am going to be trading this. I'm currently having a leverage open of about, what is it, 10x, and with this 10x leverage I basically will make a 48% here, and currently I'm only with $4,000 in this position, so I will be making around, what is it, 3,000 to yeah, $2,500 basically on the market. So that's actually a pretty interesting price target, and of course once we officially confirm the breakout right here, I will be starting to put my stop losses in profit, and I will also exactly show you guys that here on today's live stream, because I'm completely transparent with all the things I do here. Furthermore, looking at the Bitcoin price action here also on the 4-hourly time frame, we can see also the 4-hourly time frame was squeezing quite significantly in here, 4-hourly time frame forming also that symmetrical triangle. And what you don't know, I mean, what you should know actually, is that a symmetrical triangle is a continuation pattern, and a continuation pattern tends to break out towards the direction which the trend is heading towards, right? So currently we've been seeing Bitcoin has been seeing a small little uptrend, so the trend is towards the upside. We've been confirming higher highs, and together with higher lows, it means that we're trading in a small little uptrend right here on the imminent short term, right? So seeing a symmetrical triangle, it's only likely to expect that you're also going to see that breakout towards the upside. But what is now really the important target to be breaking above, right? That's the question we get many times here on the channel, and that is still the $21,000 region. It doesn't change. Nothing has changed yet so far, because zooming out on the chart right here, we can really see, okay, the 21k region, this red box of resistance on the top side, right? You can clearly see it. We got rejected, we got supported right here, we got supported right here, and we've been seeing severe rejections, and here also, by the way, support touch, right? So the $21,000 is still a very important level to be breaking above, and maybe we could be starting to see that it is going to be happening today with the FOMC meeting that's going to come around later today. And I will be also discuss it live here on the channel. So make sure to stick around for at least another 25 minutes, because in 25 minutes from now on, guys, the FOMC meeting will basically start, because it starts in literally 25 minutes from now on. So I will be discuss more about that in a minute from now on. First, I want to be finishing up my charts thoughts on Bitcoin and Ethereum and the altcoin market, basically. And also, I will talk a little bit about Doge, because I see many people are talking and asking me about Doge. Also, looking at the 4-hourly time frame for Bitcoin, we're still trading in that parallel channel towards the upside. So far, we officially have not breaking above this important resistance line on the top side. And as soon as we do break above this important resistance line on the top side, we could start to see potentially more upside is going to get followed for the price action of Bitcoin. If you look at the daily time frame on the parallel channel chart, we can see we're also still trading in it, of course. But historically speaking, the last 3 times we've been creating this parallel channel, basically every single time we broke towards the downside. So will it once again happen? I mean, let's hope the 4th time is going to be a little bit different, right? I mean, I would definitely appreciate it. And of course, to monitor it, we want to be looking at the 4-hourly time frame and at this important upward sloping resistance line, right? That is going to come in around somewhere around $21,000. What is, once again, big coincidence, this very important resistance level that we are seeing right here. So let me further on look at the price action for Bitcoin also on that the bigger picture, and basically look at this time frame. This is once again that important level of $21,000. We can see a small little uptrend is getting created, and we can even call the structure we're currently creating here in the market an ascending triangle. Sorry, excuse me. I was a little bit looking for my words, but this is an ascending triangle. We're seeing higher lows with an equal highs getting formed in the market. That's called an ascending triangle. Ascending triangle is also a typical bullish bias continuation pattern. So let's see where it is going to be heading towards. But so far, it is actually quite good development for the price action of Bitcoin, and I'm definitely looking forward towards to see where this is actually going to be breaking out towards. And of course, I truly hope it's going to be towards the upside. I mean, the odds are currently with us that it is going to be breaking towards the upside, and that is also why I am currently in this long position on the Bybit exchange. And actually, guys, if you want to be making trades yourself, check out the link in the description on Bybit or BitGet, 2 very good trading exchanges where you can trade your cryptos on. And actually, I've said it several times before, in the bear market, you want to be benefiting from these deposit bonuses these exchanges are offering you, because it basically allows you to trade with more free money from the exchange to make more gains. And right now, the profits are not found in altcoins or whatsoever. No, it's more in trading right now. So yeah, if you're interested in it, make sure to first of all subscribe to the channel, because we're making daily analysis and we've been predicting so far everything correctly as well on this symmetrical triangle right here. As of the last few weeks here, we've been doing absolutely incredible here on the channel. So consider subscribing to the channel if you are interested in daily technical analysis. Also looking at my chart with the most important downward sloping trend lines here in the history of Bitcoin, we can currently see that we are running in towards this critical resistance range right here, right? We got rejected a couple times here, and if you zoom out, it's actually a very important level. If I zoom out towards the level I'm talking about, is this touch right here. We got a rejection right here, support touch right here, support right here, support right here, support right here, rejection, rejection, rejection. So this is an extremely important critical level of resistance, and actually after we break above this level, there's a lot of room to grow towards the upside. So I honestly also expect, I've been saying this, if we break this level, we could be climbing very quickly back up towards levels around $25,000 to $24,000, and that is why I'm also willing to catch a small little long position right here, because this could be be a small little relief rally. And I will be exactly also monitor all the short squeezes that are happening on the exchanges, because currently, also an important thing to point out here, before I go further in towards my analysis and before I go more in depth about what is going to go down with the FOMC meeting, currently the funding fees are also extremely negative. And if you don't know what the funding rate is basically means that currently on the exchange of Bybit, and if I look at other exchanges as well, there are more short orders than long orders. And due to that fact, the short orders have to be paying to be in a position, because always on an order book, it's 50-50. And if there's more shorts, the shorts have to be paying to be in their position, and also the exact opposite way around. If there are more longs in the market than shorts, the longs have to be paying a funding rate. Currently, we can see then that there are more shorts in the market. So people are trying to catch the movement towards the downside, and it looks to be that we could be maybe see a small little short squeeze. So let's see what is going to be playing out on that point. We could still well see also a movement towards the downside. It could still be a significant wick towards the downside. I mean, nothing is confirmed yet so far, and I will be still confirm this. I would definitely wait very carefully before we get a breakout of this pattern. Only I've been playing the odds that this symmetrical triangle is going to be playing breaking towards the upside. Furthermore, looking at a very interesting signal, this is the the monthly time frame for Bitcoin, and actually this has been a signal that just got confirmed 2 days ago. Let me see. A signal that got confirmed 2 days ago. What is actually very interesting to see here? If we're opening up the MACD on the monthly time frame, we can currently start to see that we are having the MACD crossing officially in towards not bullish territory, but in towards a crossover phase. And historically speaking, every single time this has been happening, and I will be pointing it out right now, I thought I placed it in a chart, but actually it disappeared. Actually, every single time we do see the MACD on the monthly time frame cross from the most bearish momentum towards more bullish momentum, we basically have historically always formed the bottom in the market. So let's see what is going to be playing around this time around, because here this was in 2015. We formed the bottom exactly on the monthly RSI turning towards the upside again. And also look at how this range is coming together again here on the monthly MACD, right? We're in the same pain zone. We're basically having the same amount of pain in the market on the monthly MACD. And yeah, Bitcoin has been basically in a similar long period of downtrend in the market. And actually every single time it happened, it was also here in 2019 February, we crossed towards the upside and we had a rally back towards the upside. Do I necessarily say this time is going to be different? I mean, this time it could be different because we're currently in a worldwide recession and Bitcoin has historically never been through it, but this is definitely a signal to be paying attention towards. And today there could be some dovish words from Jerome Powell, and that could be leading towards risk assets increasing once again here, because Bitcoin has been holding up surprisingly well compared to the stock market if you're actually going to be looking at it. So take that also in consideration right now. Further on, let me quickly analyze this chart, and you can see the vertical lines. I mean, I know it's not the most favorable chart to look at because I also don't enjoy to look at this chart because it looks a little bit chaotic, but please wait a minute because this chart is actually very interesting. You can see that every single time before the FOMC meeting basically hits, we tend to see big market volatility first of all pick up. And usually, once we tend to be last meeting around, once we pumped, we dumped significantly, and then we pumped again, and then we dumped again here. So basically what we can see every single time, if we sorry, I'm saying it incorrectly. Basically, every single time on the exact meeting, we tend to see volatility pick up. That's what I want to be saying here. And so far, from the last 3 meetings, we have been seeing a pump towards the upside on every single meeting, and then maybe a dump. That was 33% of the occasion. So what I'm expecting is at least that in the coming hour, we're going to be seeing upside for Bitcoin. That is my expectation. And that is also a reason why I'm currently longing the market. Maybe I will be closing it in exactly 1 hour from now on. But historically speaking, it means that in the beginning of these FOMC meetings, we tend to see the market come towards the upside. It could drop afterwards, but usually in the first hour, it tends to be coming up if it hasn't already. So that is actually a very interesting thing I've been seeing. And I'm trying to be benefiting from the historical data that I can analyze, right? So that is a thing I want to be pointing out to you guys out there on the channel as well. Try to benefit from the market right now while the volatility is high. If you don't know at which coin I'm currently looking at, this is Dogecoin. Dogecoin has been absolutely exploding, and I do see some weaknesses in this chart. Do I think Dogecoin is a bad investment? I mean, for the long term, I actually don't think it's that worse of an investment, but currently we can see some momentum is getting lost. However, I wouldn't be surprised because it's Dogecoin to either continue further or up towards the upside. Would I personally buy in towards it right now? No, I wouldn't do so. I did bought Dogecoin like 2 months ago, once it was down more significantly. So for me, it's also, I don't feel the need to be buying it. And usually, once you're buying in towards these big pushes towards the upside, is usually not a very smart decision in my opinion anyway. So Dogecoin, I don't know. Can we trade it? Yeah, definitely. I mean, the 1 hour time frame is definitely looking like it is running out of steam, but maybe later today, guys, on the FOMC meeting, it can start to be rallying once again back towards that upside target. So keep your eyes wide open on this one as well. Looking at the Ethereum compared to Bitcoin chart, it's actually looking very interesting because ETH compared to Bitcoin is basically forming a weekly symmetrical triangle. It's creating a gigantic consolidation phase, and this consolidation phase will be breaking out anytime soon. And once this breaks out here, either bullish or bearish, it would mean basically an altcoin hype season, or an Ethereum hype up season, or a Bitcoin season if it's going to be breaking down. So please keep your eyes wide open on this. And also a thing I want to be pointing out here is that you should be very careful with altcoins right now here, because if I'm looking at the altcoin season index, it is currently not altcoin season. It's indicating that we came from an we came from an altcoin season, like you can see over here. And we're currently starting to enter a Bitcoin season. So historically, from this data report, it is not necessarily smart to step in towards altcoins right now. And it's smarter to start stepping in towards Bitcoin. Doesn't mean that Bitcoin, doesn't mean that altcoins can't be rallying towards the upside right now. No, that's not what I'm saying. I'm only saying that the risk is significantly increasing if you're going to be buying altcoins right now in terms of your exposure to Bitcoin. Furthermore, looking at Ethereum compared to Bitcoin, I think is actually a very beautiful chart. Looking at Ethereum itself, this is the daily time frame for Ethereum, a little bit more of a zoomed out view here. And basically the range of interest, the zone of interest, I should say, is going to be this it's going to be this very important white box of resistance, right? This is the zone of interest. This previously around was formed the bottom for the next big all-time high we basically reached with Ethereum, and right now it's forming the next big resistance range, right? So we need to be flipping above $2,000 significantly, not for a day, not for 2 days, but significantly for 2-3 weeks for me to really see, okay, this is a confirmation of a break above this critical level. We are forming a beautiful higher low, but do take in consideration that we're also still confirming lower highs from that top side here. Clearly you can see, right? So we're still forming basically in consolidation phase. We're forming lower highs together with higher lows. So basically we officially have not seen which direction Ethereum is right now breaking towards, just like Bitcoin is doing, right? On the bigger picture, I don't think that we clearly have seen which direction Bitcoin is heading towards, because if I right now go towards the 3-day time frame, right? I open up the 3-day time frame for Bitcoin. Do you think we necessarily have chosen a direction whether we break bullish or bearish? No, 3-day time frame is still forming a lower high every single time. So, I mean, we are not necessarily flipping bullish on the higher time frames yet so far, right? Only in the immediate short term, we are seeing some beautiful breakouts towards the upside happening. And on the 4-hourly time frame, we're seeing an ascending triangle getting created, what is of course bullish for the immediate short term. But the bigger picture also for Ethereum, I'm not fully convinced that necessarily this has to be the bottom, but it could well be the bottom. That is more my general expertise on the market right now. And also, before I continue further on in towards the video, it will be highly appreciated if you can slap up that like button right now, because we're only have got 150 likes, and I think we can easily smash it back above 300 to 400 likes. And also, if you do like the daily content I'm bringing out on the channel and these live streams on the FOMC meeting, make sure to consider subscribing to the channel as well, because my goal for today is actually to reach the 94,000 subscribers, and currently we're sitting around 93.7, and I think 250 subscribers is easily done today. So let me know if you're already subscribed, but it will be absolutely appreciated if you are, of course, going to slap up that subscribe button today to the channel. Furthermore, talking about my trade, I will be exactly show you guys what I'm going to do with my trade. I mean, I don't know exactly what to expect with the, my expectation is that the Federal Reserve meeting is going to be hiking the rates by 75 basis points. But like I told you, historically speaking, we tend to be pumping towards the upside. So I think I will be closing this trade live in the stream, and I'm thinking about doing a giveaway with the profits I'm going to be making from this exact trade here. So let me know in the chat if I should do that. But yeah, I am planning to close my trade somewhere around 21.5k if we can be reaching the target. So I'm already going to be setting up my take profit in a minute from now on, but this is definitely an interesting trade in my opinion. Furthermore, looking actually at the expectations we've got for today, in exactly 12 minutes. In exactly 12 minutes from now on, the FOMC meeting will start. Like you can currently see in the screen, we will be seeing basically this in a second from now on. We will be seeing the FOMC meeting, and I will be basically show you guys exactly what is going to go down there. So make sure to stick in the stream here, because I will be showcase exactly all the things that are going to go down here, and it will be happening in exactly 12 minutes from now on. So if I'm going to be looking at the market and the predictions for the upcoming FOMC meeting, I mean, currently if I refresh this page real quickly, let me see, let me refresh it. It's not refreshing. It is refreshing right now to see the most up-to-date rates here. We are expecting, oh, it's gone. Okay, too many people are probably going to be trying to visit this site, and that's the reason why it was initially, I think, not loading up again. But the expectation is currently that we're going to be seeing a 75 basis point hike here. And I mean, honestly, I do think it's going to be likely. But what is going to be important is to listen towards what Jerome Powell is going to say, because if he's going to talk about any dovish statements, it will most certainly mean that the market is going to be pumping towards the opposite, and especially risk assets like Bitcoin. So today is going to be an important day because many special analysts are expecting that he's going to be having some dovish terms, and we can currently see, if we're going to be looking at the rate expectation, 93% of the market is already pricing in that we're going to be hiking the rates by an approximately 75 basis points. And due to that reason, it is also likely to expect to see that happen. And let's say in case some people are saying in the chat that the 75 basis point hike is already out, but I can tell you already, it is officially not confirmed yet. And if you're saying that, you're probably speculating. And I mean, the most likely scenario is that it is going to be happening. The FOMC meeting is in, let me see, 10 minutes from now on. So make sure to get ready. It is not happening yet. It is not happening yet. Furthermore, expectation is 75 basis point. Some people are saying it is out, but I cannot read anywhere. Dude, it's already out. Where I cannot seem to find any clue that it is officially already stated. But yeah, no, and what I can see over here as well is that the FOMC meeting is starting in 9 minutes from now on. So, excuse me, but I'm trying to confirm this. But it is actually, boom. Okay. Furthermore, guys, let me know in the chat as well if you have some questions before we go out here. I don't seem to find it actually. But yeah, so far I see no official statement yet. It's out, Rover. You can check your Twitter. Oh, I mean, I'm also looking on Twitter and I can't seem to read anything. Anyways, if it's already confirmed, usually the meeting also tends to, with the meeting, the volatility tends to pick up. So meeting is happening in 8 minutes from now. 75. So yeah, with the 75 basis points, yeah, well, of course, the market has already been pricing it in. And like you can see, only 7.1% of the people were actually expecting only a rate hike of 50 basis point. And for the next meeting, it's also going to be important to see what we're going to be expecting. Next meeting, approximately 5% of the market is pricing in a 25 basis point hike. Approximately 60% is expecting a 50 basis point hike. And of course, more about that is what we will be hearing in the upcoming meeting in 8 minutes from now on. So that is going to be important to be looking at. The 75 basis point hike for next meeting is approximately 35% priced in already in the market. And for the month afterwards, so in February 2023, we are actually expecting that we're, depending of course on what kind of a rate hike we will be getting in December, that we only are going to be hiking maximum with 50 basis points on top of that. So actually it's going to be very interesting to be looking at that. Yeah, what our expectation is also from this point onwards is that actually the Federal Reserve, Jerome Powell will say basically in the upcoming FOMC meeting that that he will be probably slow down the rate hike. And due to that fact, I am expecting the markets are going to be pumping furthermore towards the upside here. So let's see, 7 more minutes to go. Let me see if I have the chart I want to be talking about actually. Boom. So this is the 15-minute time frame for Bitcoin. Historically speaking, if we look at the previous events here, is that only once the meeting tends to start, we tend to see the volatility really pick up here. Before the meeting, we tend to see, of course, a small spike up or down. But once the meeting starts and Jerome starts talking, we basically tend to see the market really move. And still, I want to be pointing out the most important resistance right now on the 1 hour time frame is definitely this 20.5k level, and we're starting to be breaking towards the upside. And this has actually been one of the most beautiful symmetrical triangles we're currently seeing here on the market. Meeting in 6 minutes, guys. Yeah, indeed. Meeting in 6 minutes. So 6 more minutes to go before the meeting comes. And currently, officially as well, the rates from the US are the highest since 2008. That's actually pretty interesting to see. We're currently at the highest rate since 2008. That is actually pretty impressive to see. So yeah, we can currently see it's sitting on 4%. And that brings the rate hike the highest as it has ever been since 2008. And that is quite a long time back already. So that is actually pretty interesting to see right now. And we will be hearing in the meeting next what is going to be happening. But first, before I'm going to be talking about the meeting, I actually want to be talking about something very breathtaking. And I have to scroll down a little bit here towards this very important tweet. And that's also the reason why you should be following me on Twitter. But look at this chart, first of all. I say this is the time to be buying Bitcoin. Why? Is because historically speaking, the Fed funds rate, the time frame between the last rate hike and the first rate cut, usually tends to not be that long. Like you can see, the longest period was 15 months. The shortest period was 2 months. And the shortest period was also in the previous time where the inflation was so extremely high. So what I want to be pointing out with this is that basically, once the Federal Reserve is going to be go dovish, once they're going to be stopping the rate hike, it could be going very quickly. It can come down, and it can come down very quickly again. And due to that, risk assets could be increasing very quickly. So maybe in exactly 1 year from now on, things are going to be looking very, of course, in 1 year from now on, everything will be looking different, but it could be looking different at a very rapid pace. Also, look at this. We're currently in a quantitative tightening phase. Usually, we tend to see the markets still rally, but in a very slow ways. In a QE, we tend to see a bull market getting started. And currently, we're of course in quantitative tightening, and the market is starting to come down. And I'm currently talking about the S&P 500. Usually, the big setbacks tend to come once QE stops. And the question is, when will QE starts again? And that is maybe also an answer that we potentially can get. And of course, I'm not expecting we're actually going to get it, but that's an answer we're going to be looking for in the FOMC meeting. So, what I can basically see from these images right here is that basically once the Federal Reserve turns around, it usually turns around very quickly. And what I am expecting as well is that the Federal Reserve not necessarily can keep these rates so high for a long time, because probably they will create a debt spiral. And that is, of course, a thing that they do not want to be having, right? So that's going to be interesting to be looking at. Right now, I'm going to be preparing myself for the upcoming FOMC meeting while Bitcoin is pushing on further towards the upside. I'm going to show you guys real quickly. Boom, let me open up this. Let me open up my trade as well. And let me set up the meeting screen here. Boom, where you guys can basically see what is going to go down here in the exact meeting. Boom. Yeah, guys, we're only a few minutes out here. To be exact, less than 2 minutes. We're less than 2 minutes out here. I will be putting it on the top left side of the screen. I think that's better. Let me quickly refresh this page because it will make it a little bit easier. Boom. I will mute it for now because the sound is absolutely terrible. But we will be watching this all together, guys. And we will be as well watch the chart to see how it is going to be unfolding on the price action of Bitcoin. Now let me put it actually to the 5-minute time frame to see exactly what is going around here, right? So let's see. Boom. Hold on, guys. Hold on. It's going to be in a crazy rides. It's going to be crazy rides. Give a like to Crypto Rover, DustTBC. Thank you for tuning in. That's absolutely a pleasure. That's an absolutely pleasure. You're the biggest moon boy. Every day it's breaking upwards, laughing my ass off. I mean, then you definitely have not been watching the channel, actually. Yeah, you could be saying so. But I mean, I'm honestly just looking at the trend, where the trend is heading towards. And right now, while you're watching the stream, we are seeing the trend is breaking towards the upside for Bitcoin. So it's just trading where the trend is heading towards, my friend. So we've been shorting the market also quite frequently. We've been expecting the market to go down also quite frequently. So yeah. Dude, the market is responding. Probably a dump right now. Like I told you, historically speaking, we tend to see a pump in towards the coming hour from now on, and then we could be starting to be expecting a dump. And I will be exactly also trying to anticipate this with my trade right here. I will be already set up a stop loss actually in profit right now here. So if you are actually planning on and joining me with a trade here, be careful. I mean, I've already set my stop loss in profit. Make sure to trade at your own risk. And of course, it is always smart to use a stop loss. And like you can currently see on the screen. Oh, sorry, we're beginning, guys. Let me set it up. The meeting is starting. Sorry for the small glitch. Sorry for the small glitch. It's about to start. There he is. There he is. Let's go, guys. There he is. Bitcoin moving up severely in a very
Good afternoon.
pace.
My colleagues and I are strongly committed to bringing inflation. We have both the tools that we need and the resolve it will take to restore. Price stability on behalf of American businesses. Restore price stability on behalf of American businesses. Price work for anyone. In particular, without price stability, we will not achieve a work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market.
Quickly loading it up anywhere.
All increases will be appropriate. We are moving our increases will be appropriate. We are moving. In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Excuse me, the website was not working that well.
Maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
Here it comes.
There is significant uncertainty around that.
Now the volatility will start to pick up most likely.
Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level
I never have internet connection issues. The stream is also running okay. I just can't. I don't know what is going on. It's not loading up. Come on.
Level of
oh, here it is. It's back
great
again.
demand so that it comes into better alignment with supply.
Now the volatility will most likely start up, guys.
Using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job
could become a fake out.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability.
Oh, I got stopped out. Okay, fortunately enough, I've got my stop loss and profit. I don't know what it is going on here. My internet is always okay. But, whoa, Bitcoin is dumping severely. This could be just a fake out right here, guys.
Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective. over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0.
We have to wait for an official confirmation on this breakout, guys.
Certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made.
Very bullish.
It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to
very bullish.
The pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't, of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors. You don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So potential financial, doesn't appear to present financial stability issues, but no, we do understand that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings.
For the people that are asking, I got stopped out in profit.
Level that's well above
Like
the
you can see
level
here.
that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a time, difficult time in the global economy. We're seeing we're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators like Elizabeth
We closed
Warren
another
are saying
1
that this
hourly
is
candle,
sign
just
of
saying this real quickly,
greater,
exactly still in the
problems
pattern.
with
So
the
we're
Fed.
still waiting to
Could
see
you talk
which
about
direction we're
what
breaking towards.
this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. We now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is, once you, so I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, And that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to, ordinarily there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
That's a wrap. That's a wrap. Okay, that was the meeting. The meeting officially has ended. So that has been pretty exciting, actually. We have been hearing a lot of stuff, but in the end of the day, did Bitcoin move up or down after this FOMC meeting? We can say Bitcoin basically stayed the same. So we are still waiting for the next big move to be happening. We're still consolidating in the pattern. So what I will be looking at right now, actually, after this meeting is done, right now everything's settled down. The market volatility will probably come down a little bit here. However, we are still in this squeeze pattern. We can clearly see in the 4-hourly time frame as well, Bitcoin is forming lower highs, it's forming higher lows. It is just going to come towards an end anytime soon. Whether it's going to be today or tomorrow, the Bitcoin price action is squeezing. What can we summon up from of this meeting? Actually, very interesting to know. Very good question. What we can basically see here is that probably in the upcoming meetings, in the upcoming Federal Reserve fund rates, interest rate hikes, we could expect that the Federal Reserve is going to be taking it a little bit slower. So we could be expecting to get maybe a 50 basis point hike rather than a 75 one in the next upcoming meeting. That is my expectation, at least. That is a little bit what I understand about what Jerome was talking about. And I mean, he is, of course, saying he's not going to stop until inflation is under control. But let's see how it's going to be playing out, because I don't think that the Federal Reserve can go much higher than maybe 6 or 7% on the interest rate. So we are coming towards a roof. Currently, we're sitting around 4% in the interest rates. Let's see how much higher we will be going. The next meeting will be very important to know here. So make sure to stick around here, because the next meeting is going to be... I closed the website. Oh no, it's here. The next meeting is going to be on December 14th. So the next, in December 14th. So in approximately 6 weeks from now on, we will be knowing exactly what the the funds rates is going to be around that time. So we have to be waiting for that here. But actually, it's going to be very interesting to see what is going to be happening afterwards. But currently, what we can say about Bitcoin is basically nothing has been changing so far. So yeah, let's see what it's going to be playing out like. But anyways, this was it for me on today's live stream, guys. It was an absolutely pleasure to be your guest today for the FOMC meeting. It was a pleasure actually trading Bitcoin. I mean, I got stopped out in profit. I did clearly set up my orders. Unfortunately, I got stopped out in profit. So yeah, it's quite alright. Tomorrow, I will be back with another video. I will keep you guys up to date in my Telegram channel and on Twitter because, yeah, I will be still honestly trying to catch this exact breakout right here on the 1 hour/4 hourly time frame because Bitcoin is squeezing up quite nicely right here. So if you're interested in trading, like I told you, make sure to benefit from the exchanges that are currently offering insane deposit bonuses, and BitGet is definitely also a very good exchange to take your trades on since they're giving you a rebate of 2 weeks. So yeah, guys, thank you so much for watching towards this amazing new update video here on the channel live stream. I'll see you guys back tomorrow with another live stream. Peace out. Goodbye.